Hello everyone, and welcome to Module 11 of our Financial Modeling course, delivered on behalf of SNB experts. Today, we're diving deep into valuation techniques to determine what a company is truly worth. We'll cover everything from discounted cash flow models to relative valuation methods. Let's get started. In this module, our goal is to master several key valuation methods. We'll learn to build discounted cash flow models, calculate free cash flow to the firm and to equity, and apply terminal value methods. We'll also explore comparable company and precedent transaction analysis, along with fundamental decision metrics like NPV and IRR. The discounted cash flow model, or DCF, is a fundamental intrinsic valuation tool. It calculates enterprise value by summing the present value of future cash flows and the present value of the terminal value. Key components include the forecast period, free cash flows, and the discount rate, which is typically the WACC. Now let's talk about the weighted average cost of capital, or WACC. This is the discount rate used to adjust for the risk of the cash flows. It combines the cost of equity, often calculated using CAPM, and the after-tax cost of debt, weighted by their respective proportions in the company's capital structure. It's crucial to understand the difference between free cash flow to the firm and free cash flow to equity. FCFF represents cash available to all investors and is discounted at the WACC to find enterprise value. In contrast, FCFE is cash for equity holders only and is discounted at the cost of equity to find equity value. To value the company beyond our explicit forecast period, we use terminal value. There are two main methods: the perpetuity growth method, which assumes a constant long-term growth rate, and the exit multiple method, which applies a multiple to a final year financial metric. Terminal value often represents 60 to 80% of the total DCF value. Moving on to relative valuation, we use comparable company analysis. This involves looking at trading multiples like EV to revenue or PE ratios of similar companies. It helps us understand how the market is valuing firms within the same industry and provides a benchmark for our target company. The process starts with selecting comparable companies based on industry, size, and growth. Next, we calculate trading multiples for each company, determine summary statistics like the mean and median, and finally apply these multiples to our target company's metrics to find an implied valuation range. Precedent transactions analysis looks at historical M&A prices for similar companies. Unlike trading comps, these prices often include a control premium, usually between 20 to 40%, reflecting what an acquirer is willing to pay to take control of the firm. It's particularly useful for valuing a company in a potential sales scenario. Valuations are highly sensitive to assumptions. That's why we perform sensitivity and scenario analysis. By varying key inputs like WACC or growth rates, we can see a range of potential outcomes, helping us understand the risks and the stability of our valuation under different economic conditions. Finally, we use decision metrics like net present value and internal rate of return to evaluate investment opportunities. A positive NPV suggests an investment creates value, while we accept projects where the IRR exceeds our required return. NPV remains our primary criterion for maximizing value. To summarize, mastering DCF, relative valuation, and decision metrics is essential for accurate company valuation. I hope this module has been insightful. Please make sure to subscribe to our YouTube channel, SNB Experts, for more professional training. Thank you for following. Goodbye and see you next time.